let's pick up where we left off then. And these were the administration proposals. Just mention those to keep those in your mind. Just think about that. Now, somehow we got cut off on the top of that one. But general approaches to estate planning currently, post American Taxpayer Relief Act of 13. The new normal, of course, is certainty. We know what the rules are until Congress changes them, meaning they're not scheduled to sunset at the end of this year or at the end of last year. We know what the rules are. We have indexed exemptions, we have portability, and we have very little impact on most clients, as I said. Less than 0.2%, less than 0.2% of all decedents' estates are subject to federal estate tax. But again, for those people to whom it applies, it's a big deal. And planning is very important, and it is disproportionate in terms of its impact on small businesses and farms and ranches. But total, if you take all of the deaths in the United States in any given year, there's a little bit over 2 million every year, less than 0.2% would have any estate tax liability. Okay. Planning for married couples under 5.34 million. Let me just kind of give you some general, we're talking estate planning here. And again, this is part of the overall business plan, succession plan, but talking estate plan. If you have net worth over the married couple under 5.34 million, so under one level of the exemption, which is 5.34 million this year. That'll adjust upward next year, so you'll have to move that number. Transfer taxes in generally are not irrelevant. We don't care about federal estate tax. It's not an issue. You don't have to worry about estate tax in Kansas. If I were somewhere else where they had a state death tax system, then we'd have to talk about that. That would be relevant. But watch your beneficiary designations on retirement plans, Roth accounts, IRAs, life insurance, anything that has a beneficiary designation, make sure that that corresponds to your overall goals and objectives of your estate plan. Income tax planning is the big issue, and preserving stepped-up basis at the death of each spouse is absolutely critical. That's the rule that you want to take advantage of. Property included in a decedent's estate at death receives a new basis equal to the fair market value of that property in the hands of the person that inherits the property. Okay? Thank you, Joni. So stepped-up basis is absolutely critical, particularly for, let's say, farmland that's been held for many years, and it has a low basis in it, maybe going back 30 or 40 years, maybe even further. It's nice to wipe that low basis out and wipe out all that appreciation, include it in the estate, have it inherited by the next generation so that they've got a higher basis if they would have to sell. Maybe eliminate capital gain on the sale. That's a big issue. So maintaining stepped-up basis at death and at the death of each spouse is absolutely critical. We typically do not want to do things that's going to limit that stepped-up basis. So we include it in the estate, subject it to tax, but because we're beneath 5.34 million, we don't have to worry about tax. So income tax basis step up is the big issue. Now, if we're going to use a trust to do all of this, we want to give the spouse what's called a testamentary, or at time of death, power of attorney to allow the basis adjustment on the surviving spouse's death. So what I'm saying there are just some additional steps that we need to watch if we're going to leave property in trust to a spouse to make sure we preserve stepped-up basis in the hands of the surviving spouse. We want to also maintain standard of living. Make sure that the surviving spouse, their standard of living can be maintained with respect to their expectations. So that gets in financial planning as well as business planning. Maximize out the qualified retirement plans to the extent we can. Do our elder law or Medicaid planning, and then our asset protection planning. What can we do to protect assets from creditors and claims of creditors? So those are the real issues for the vast majority of people where combined spousal wealth is 5.34 million or below. For couples in the middle range, 5.34 to 10.68 million, currently between 1 and 2 times the exemption level, then that portability decision is what things come down to. Portability portability decision. And typically, you're going to want to leave that decision up to the surviving spouse. I would suggest the surviving spouse make the election to carry over the unused exclusion from the first spouse's estate. There may be things to do with respect to what I would call disclaimer trust and disclaiming assets. That's a very technical issue. But it comes down to the portability election in these middle range estates. If you're above 10.68 million on combined net worth, then it's a different ballgame. We're beyond what can be covered by 2 exemption equivalents of the exclusion. So even if we carry over a full exclusion at the death of the first spouse, that just gets us to 10.68 for the surviving spouse, and we're beyond that. So what do you do if you're in this realm? Well, then you get into gifting. Utilizing present interest annual exclusion gifts, $14,000 per year per donee, to chip away at that. That's a good way to move property into the hands of the next generation completely tax-free. The drawback is when you gift property, the donee takes the donor's income tax basis in the property. So it's a carryover basis. You're not going to run it through the donor's estate because they're going to give it away, so there's no stepped-up basis, and they get a carryover basis on that property. And that's the downside. But it is a good way to move property into the hands of heirs tax-free. Now, if they're not going to sell the property, let's say it's interest in a business, and they're there to be the on-farm heirs, and you're transferring stock by gifts, if the idea is they're not going to sell that stock, or they're not going to sell those assets in the entity, then it's not an issue. You know, the lack of basis step up is, to many people in that situation, irrelevant. So then we look at it from a transfer tax standpoint, and that's a great way to move wealth from one generation to the next tax-free. So gifting is an issue. Gift splitting, this is a technique that's available between spouses. Let's say one spouse owns property and you want to move that to a child. Well, the one spouse has a $14,000 exclusion. So does the other spouse, but that spouse doesn't own this property. Well, you can file a gift tax return, which is a Form 709, and check a box to elect this, basically make an election that treats both spouses as equal owners so that you can get 2 exemptions on that. You can get 2 $14,000 present interest annual exclusions on that. So you can move $28,000 to a child tax-free. But you got to file a 709 to do that. But watch your loss of stepped-up basis on gifted property. And there are some other techniques we could talk about too. But gifting and the use of charitable gifting and charitable trusts is a big issue and a big planning tool for couples in that realm. Now, let me shift gears a little bit. This is outside of the estate tax realm, the transfer tax realm, but we've got 4, or actually 2 major Obamacare taxes that have kicked in that do impact business planning and the structure of the business and types of income that we have. These both started at the beginning of 13, so the tax returns that are being filed right now are the first ones that have to account for this for certain clients. The new 3.8% net investment income tax that started on January 1 of 13, the NIIT, net investment income tax. That is a tax on passive sources of income. So retirees will get hit hard with this one, this additional 3.8. Somebody that sells a non-business asset, somebody that has rental income, royalty income, oil and gas royalty income, gets an additional tax, 3.8%. Okay? Passive sources of income that don't get reported on a Schedule F or that historically have not been put on an F. That's passive probably, depending on where it's going and what it is. But Schedule F income is not subject to this. It's non-Schedule F income, non-farm passive sources of income. That's one of them. The other one, since we have a passive tax, they've added an active tax. Okay? That's an additional 0.9% on wage and self-employment income. Wage and self-employment income. Okay? You remember what the other thing that happened under ATRA was that the Medicare tax went up. Congress did not extend the tax break on that, so you got a 2 percentage point increase on that. And then you got a tack on, starting in 13, on another additional 0.9% on certain levels of income on wage and self-employment income. Okay? Those are the 2 additional taxes. Let me go through particularly the one that is the 3.8%, because that influences what we do from an estate planning and a business planning standpoint. So it's the NIIT, the net investment income tax, okay, 1411 tax, that's what we're going to talk about. I'll refer to it as the NIIT. But that's that additional 3.8. So what is net investment income and what are the exceptions to this? Okay. How many of you have heard of this? Okay, a lot of people have heard of it. Yeah. How many know that it's going to be on your 2013 return? You're going to get hit. Okay, yeah. What can we do to avoid this? What are the exceptions to this? Well, it affects individuals, trusts, and estates that have passive sources of income. It applies to the lesser of the taxpayer's net investment income for the year or their amount of modified adjusted gross income in excess of a threshold. So what's your threshold? Now it's modified adjusted. Once your modified adjusted gross income gets up above a certain level, then we've got to look to see what sources of that income is passive to apply this tax to it. So you really have to do 2 computations. You got to compute modified adjusted gross income, and then out of that, if you're above the threshold, and I'll tell you what that is in a moment, then out of that excess, or out of that amount that has gotten you over the threshold, how much of that's passive? And then apply the 3.8 to that. Okay? So gross income, these are the passive sources of income potentially subject to this tax. Interest, and dividends, and annuities, and royalties, and rents. Those are going to be the big ones. Okay? I'm cash renting out my pasture. Cash rent's passive. Crop share rent's not passive. Livestock share rental income's not passive. Crop share, or excuse me, cash rent is passive. Yeah. Okay? Gross income derived from a passive activity. I'm going to get into that. If you got income from a passive activity. I used to run a farming or ranching operation, and now my spouse and I are retired. We moved to town, and we cash rent out the land. That's passive. That's gross income from a passive activity.
What about hedging income? Would that be?
Excuse me?
Hedging income?
Hedging income, yeah, we've got another issue here. Gross income derived from a passive activity or the trader business of trading in financial instruments or commodities. His question was, what about hedging income? Now, hedging income, we can carve that up into 2 subsets. Hedging income is tied to my trader business. Speculation is not. So, with respect to commodities, when am I hedging and when am I speculating? Well, I can tell you what a lot of people say, well, if I lose money, I'm hedging. Why? Because my losses are fully deductible. Yeah, it doesn't work that way. That's what people want to do. Okay. If I make money, well, okay, I'm speculating. No. It has to do with risk. It's a risk issue. But the line between hedging and speculation, hedging is you do it as part of your business. That's business income. And a loss would be fully deductible if it's truly a hedge. IRS has rules that we follow with respect to hedging transactions. If you're speculating, that income's going to not be tied to your business, and that's going to be passive income unless you qualify as a trader. But then if you qualify, trader, D-E-R, if you qualify as a trader, now you're trading in financial instruments and it's passive. Yeah. Okay.
Is there anything excluded?
Is there anything that's excluded? Wage income, self-employment income, that's not passive. But if you've got wage income, it's subject to self-employment tax. So you get 15.3 there, or you get 3.8 if it's passive. It kind of gets you coming and going. Yeah. Okay. And net gain, look at this, net gain attributable to the disposition of property. Net gain, I dispose of property. That's passive. The general rule is it's passive. It's always passive. There are exceptions to the general rule that impact planning, and we're going to talk about that. All right. I'll give you examples of all this stuff. I know it's kind of esoteric. What's your threshold? $250,000 on married filing joint return. Everybody else, $200,000. So once your modified adjusted gross income gets up above that, then you got to worry about the 3.8. That's your threshold. Okay, 250. Sell off a piece of land. That income's going to go in your modified AGI calculation. It's going to be up over 250. See? Have some rental income, some royalty income. Yeah. Form that this gets reported on, the 8960. And I just had an email that came in yesterday while we were traveling, and this individual had income that was not subject to the tax, but it was net gain from property. The general rule is it's subject to the tax, but if you meet one of the exceptions, it's going to go on line 5B. Net gain or loss from disposition of property that is not subject to the tax, you still have to report it. You still have to file the form. So the 8960 is what your practitioners are going to be dealing with. This is just a draft. It's not, that language is not showing up on the screen. If you look at my computer, it says draft. But nevertheless, this is the new form. If you want to go to the IRS website and pull it down and look at it, just to familiarize yourself with it, it's the 8960. Now, I've got some questions about this. If you look at line 4A, if you can't read it in the back, it says rental real estate, royalties, partnerships, S corporations, trusts, and so forth. So you got to report all of that. That's passive. Now 4A says income from rental real estate has to be listed, but it doesn't make any mention of income from personal property leases. Why is that a big deal? Well, let's say I might have farm ground that I rent out, and I rent out the machinery with the farm ground. 1402A1 of the code, which is the self-employment tax section, says rents from real estate and personal property leased with real estate are not subject to self-employment tax. Which means what? If it's not subject to self-employment tax, it's passive. But then you go back to the form and it says just report rental real estate. It doesn't say anything about personal property. 1402 would indicate personal property tied with real estate, not subject to self-employment tax, therefore passive, but the 8960 doesn't talk about it. Okay? So how do we handle these personal, there's a lot of, in the ag sector, a lot around here, where you're leasing land and you're leasing machinery with the land. None of that's under a cash lease situation, none of that's supposed to be subject to self-employment tax, but what about the 3.8? The cash rental income from the land is, but the IRS is not picking up the personal property portion of that. Okay. So it seemed that real estate rents and personal property that's leased with real estate would both be investment income. I think that's an interesting omission. You might think, what in the world is he talking about? But I think it's interesting. Line 5A, if you go to 5A, it says net gain or loss from disposition of property. But by including a net loss, because it says gain or loss, to offset various categories of investment income, it seems to be what you're able to do. The preamble to the regs issued last December says you can't do that. They have now cleaned that up in the final regulations. I'm going to show you examples. We're going to run a farmer through all of this and show you how this works and try to connect the dots for you here. But it's 3.8% for a trust. Now watch this. And there's a lot of ag property out there that's held in trust that a surviving spouse holds in trust for life, remainder to the kids. Tons of it. And the spouse has the income off the trust for life. This is that marital bypass credit shelter trust. What about this passive tax now? The tax, again, is the 3.8% on the lesser of undistributed net investment income for the year, or the excess of AGI or the beginning amount of the highest tax bracket for the trust. That's the lesser of these two. Does anybody know what the beginning amount of the highest tax bracket for a trust is in 2013? $11,950. You build up trust income to the $12,000 level, now you hit the passive tax. Ouch. That's horrible. So that means you got to get that stuff distributed out of the trust, taxed to the beneficiaries so that we can use their income, their marginal tax rates, not the trust. That's a nightmare. This is a huge problem that's out there because it's the lesser of the undistributed net investment income for the year, or the excess of the trust AGI, or the beginning amount of the highest tax bracket, which last year was $11,950, and with the inflation adjustment this year, it's $12,150. Really low. Trusts have compressed tax brackets. So do estates. Okay, trader business. What's a trader business? If you're in a trader business, the income from the trader business is not passive. You don't have this new tax to worry about. Well, if it is a trader business that's generating net investment income, it's one in which the taxpayer's activity is passive, and we'll skip the second part. But if you're passive in your business, then your income from that business is subject to 3.8. So it's a passive test. Okay. What's a trader business? Under Section 162 of the Code, that includes rental income earned in the ordinary course of a trader business. This is an exception. So this would be income that's not passive. So rental income that's earned in the ordinary course of a trader business by a real estate professional. So I rent property, that's my business. Okay, that's not passive. So that's in which the taxpayer materially participates. Or it's not a passive activity under Section 469 of the Code. And that's the passive loss rules. That's that second one that's going to apply to farmers. We don't want to be passive as defined under the passive loss rules. Okay. I'm going to skip that. I'm going to go straight to the example on this just to explain this. We have a lot of farmers that do this. I rent to myself. This is the self-rental situation. This is a big estate planning, business planning setup. We like to do these types of things. Farmers do this. Doctors have done this for decades. I've got a medical practice. I work at the hospital. I got my own clinic. I own the machinery and the equipment in my clinic, all the medical devices, and I just rent them to myself. It's a self-employment tax deal that I'm minimizing SE tax is what I'm doing. Farmers do this too. So let's say Farmer Bean operates his farm as a sole proprietorship, rents land from Landco LLC. So he's taken his land and he's put his land in an LLC for estate and business planning reasons, for limitation on liability purposes. He's got the land in an LLC. Now, he didn't put it in a C Corp. 40 years ago, he would have put it in a C Corp. That's not good advice anymore because Congress changed the rules in 1986. Now we've got people that call and say, how do I get this land out of the C Corp without 2 levels of tax? And of course, the snotty response real fast is die. Well, that's not an option. Okay, well, we can talk about some other options. But death does heal the problem there, at least from my perspective, probably not from the caller's perspective. I actually got a nasty letter one time on that. I said, some people can't take jokes, or understand when I'm joking. But nevertheless, maybe you'll figure that out. He operates his farm as a sole proprietorship, so he rents land from Landco LLC. He's put his land in an LLC owned by him and his wife. He's got to have the land to operate, so he rents the land to himself to operate it. You got it? Do you see how the structure is? Okay. The cash rent income flowing through the LLC. So he's got cash rent going to the LLC for the land that he's renting from the LLC to farm. That's non-passive since it's being rented to his Schedule F farm activity and he's materially participating in that farm. That's not passive. He's renting it to himself so he can farm it. That does not generate passive rental income. It's not passive for both income tax as well as the NIIT. Any resulting gain is not passive. Now assume he puts it in a C corporation for whatever reason. I would not suggest that he does this, but let's say that he's got this C corporation that's out there and, he doesn't put the land in the C corp. I'm thinking of a different scenario. He farms in a C corp, so he's not a sole proprietor farmer. He's a C corp farmer, and there are reasons to do that. Let's say we kept the land out of the C corp. He's in a C corp, maybe he's providing some fringe benefits for employees, those types of things. The land is still in an LLC. So now you got the LLC owning the land, his farming operations in a C corp, and he's paying cash to rent the land to farm it in a C corp. That's still self-rental income, it's not passive. No NIIT tax on that. Any resulting gain is not passive, but there's a problem here. We can't group. And I'm going to show you an example of grouping activities in just a moment. I know this new tax, it gets deep. But this does influence the type of entity structure that we're going to choose now. We did not have this as an issue 2 years ago. We now have it as an issue in terms of how we structure operations. Now assume that Farmco is an S corporation, so he operates in an S corporation. And he still cash rents farmland from Landco, which is an LLC. It's self-rental income, not passive. He can make an election to group Landco and Farmco as one materially participating activity, and I'll show you why that's important in a moment. He can't do this with a C Corp. He can do it with an S Corp. And the reason that you would do this is that makes all income or loss materially participating and not subject to the passive loss restrictions. The inability to group activities when you have a loss in your farming operation is a big hit. That is where you would not want to be a C Corp. So we'd want to suggest operating in some form other than a C Corp so that we can group in case we have losses. Our losses are not passive. If we have passive losses, ability to deduct those losses is going to be substantially limited. I'm not going to get full deductibility of my losses if they're passive. That's a problem, a new problem we've got with respect to C corporations and the self-rental situation that farmers have. Okay? Any resulting gain, you can't see it, but any resulting gain is not passive. But this is the big issue. And that's one advantage that S corporations have now over C corporations that wasn't there prior to the effective date of this new tax. Okay, and this is just discussion with respect to the grouping decision and grouping elections. That's pretty technical stuff. I'm going to pass on that. But let me show you this one here. This explains the grouping issue without me going into the detail that was on the prior slides. Let's say Farmer Bean has Schedule F income of $175,000 and interest income of $20,000 for 2013. And assume he's single. What's your threshold for this new tax? Do you remember the number for a single person? 250 is married filing joint. 200 is single. Okay? So you got a single farmer. He's got $175,000 Schedule F income. He's got interest income of $20,000. So he's at $195. He's beneath the threshold. Okay? Under the threshold, he's not allowed to make any regrouping elections. So he can't regroup his activities like the C Corp and the LLC. He can't regroup because you can only regroup if you're over the threshold and the tax applies. That's what the prior slides were telling us, were walking us through. But let's say it goes to a CPA and the CPA says, well, there was a mistake here. They find $10,000 of additional farm income that they didn't report on the original return. Now he's got to file an amended return, throw that $10,000 in there. Now what's his gross income? Up over the threshold. What IRS has said is you can go in and group now. When that amended return is prepared, he can go in and make a regrouping election at that time since his gross income exceeds the threshold and he's bound by that election going forward. Why is this a big deal? In case he's got losses. In case he's got losses, this will make the losses not passive and fully deductible. That's a big deal. Because you might run into a situation where you have a weather disaster, you've got a drought, you run into some losses. This is a new thing that impacts estate planning and business planning, where we want to be able to group. I can't do this if I'm in a C Corp, so I want to stay out of the C Corp structure for this purpose. I think the C Corp, you just simply get more flexibility. And this is another way you get more flexibility if you're not in a C Corp. Okay. If you're just not in a C Corp, we tend to push people to LLCs, not so much partnerships anymore, but LLCs and S Corps, particularly with respect to this new law. Not so much on C Corps. I'm not dinging them. There are reasons to have a C Corp, but this is one of the reasons not to have a C Corp. Now assume he actually had 185 Schedule F income when he filed his return, and 20,000 of interest income, so he's over the 200 threshold. He can make a regrouping election. Later on determines that $10,000, the CPA finds another $10,000 of expenses that needs to be reported, so he files an amended return. That pulls the 205,000 down to 195, and what happens here, he has to reverse his regrouping election. So you've got to go forward and backward on this thing, depending if you have to file an amended return that throws you over the threshold or not. Okay. Under the proposed regs, all rental income was passive, unless it rose to the level of a trade or business, and there was no bright line for a trade or business. And there are some tests for real estate professionals. Farmers just do not satisfy these tests. You got to spend more hours on your real estate activities than your non-real estate activities. So you got to spend more hours on renting real estate than you do farming or anything else. And you had to perform more than 750 hours of services during the year in real property trades or businesses in which you materially participate. And if you did this, you can also group all your rental activities together to get to that 750. Very difficult for farmers to satisfy that. That's truly for real estate professionals. Okay, the rules put in a safe harbor for real estate professionals. And I think I can skip that for our purposes here in terms of whether the safe harbor is satisfied or whether it's not. The one I want to talk about that's the big one is this rule here. All gains from the sale of property are generally passive. I sell off some land. General rule is passive. Are there exceptions to the rule? Yes, and that's what we need to look at. What are these exceptions to this rule? If property was held in a trade or business, that's an exception to disposition of property being passive. Okay? As long as it's not passive to the taxpayer, I was materially participating in the business, then the income from the disposition of that asset does not generate passive income. This has application to the owners of sole proprietorships, S corporations, and partnerships. And it takes a lot of the gain from the sale of business property out from the definition of the net investment income tax. It also covers the sale of goodwill, such intangibles, which would include goodwill. But what's a disposition? Basically, anything you do with that asset that triggers tax. You could sell it, dispose of it, transfer it, convert it, cash settlement, cancellation, termination, all of that stuff. Gain that's deferred or excluded for income tax purposes. We don't worry about that generally. So if I enter into a tax deferred exchange, some of you have probably done tax deferred exchanges of land. No, that's not subject to the 3.8% tax. Until you, at some point in time, eventually include income from that in taxable income, if ever. So like-kind exchange, we've also got the principal residence exclusion, up to $500,000 on a joint return. We just tend not to pay gain on the sale of a residence anymore. Okay? Unless you're on the, what is it here, the west side of Arlington where the expensive homes are at, or is that the east side? That was a joke, by the way. Okay. Maybe not, I don't know. First time I've actually stopped in Arlington other than just driving through it to get to somewhere else. I did not think that we'd find a gym here like this. This is pretty nice. You know, a lot of these have been torn down over the years. I don't know what the town has done to keep this alive. This is kind of nice to see this. Is this a community building now? Yeah? Yeah, that's good to see. Okay. I think I can skip that one. Some farmers are going to have this. Farmer Bean, let's say, has some investment. He's wise. He's got some investments. He's done his estate planning, his business planning. And he's got some IBM stock. And he sells the IBM stock for a $15,000 loss, which also generated $5,000 of dividend income during the year. He has no other gains or losses or investment income for the year, so he gets to deduct $3,000 of capital loss against other income. That's the traditional rule of the limitation on deductibility of that type of loss. But what about this new tax? For investment income tax purposes, his net investment income is $2,000. So he takes the $5,000 of dividend income. Now he had $15,000 loss. He also got $5,000 of dividend income. So he's got $5,000 of dividend income less the capital loss that he takes. So not only does he have a $3,000 capital loss, he's got $2,000 of NII subject to tax at the additional 3.8%. Another complication that's come in 2013 on your investments. Okay, I'll skip that. We'll cover this one. Farmer Bean's got a long-term capital loss of $25,000 from the sale of Microsoft stock. He has $50,000 of interest and dividend income, has a gain of, well, let's say he's got other investments out there, so he's got interest and dividend income, has gain of $35,000 because he sold some farm property. So he's got, this is all passive, this might be passive. Well, how do you handle all of this? Well, under 1231, his gain from the sale of the farm property is treated as long-term capital gain. That's going to offset the $25,000 of the Microsoft stock loss for a net capital gain of $10,000, and that'll be subject to capital gain rate, probably at the new 20% rate on that. So again, another complication with this 3.8. Okay, I'll skip that one. But this is the big question that we get quite often. There are three situations that can come up with respect to farmers, at least as I see it right now, on the question of whether when I sell my farmland, is it passive? You've got the situation where you've got an active farmer that carves out a piece of ground, maybe sells it to a kid to get the kid established in farming, or just sells it to somebody else to generate some income. Is the sale of that farmland subject to the additional 3.8%? In other words, there's going to be capital gain on the sale of that land. Let's assume that it is the 20% rate. Are we going to tack on the additional 3.8 to that or not? This is an active farmer who's still farming, carves out some land, sells it. The answer is no. No 3.8 on that. Why? Because he still has Schedule F income. He's a materially participating farmer. Yes, it is a disposition of an asset. The general rule would say it's subject to 3.8, but he's materially participating. Okay, that one's easy. No 3.8 tax on that. What about the couple that comes in, they go to the CPA, they go to the lawyer, they're trying to plan this, and they said, look, we retired from farming a number of years ago, moved to town, we've cash rented the land out for a number of years. Now we're seeing all these reports coming out of K-State, coming out of Iowa State, kind of troubles us a bit. It seems to indicate the land market has softened, and we think that this is a good time to sell. We sold some land. Is it subject to the additional 3.8? The answer is it depends. What's it depend upon? Whether they're passive or not. Are they materially participating? Well, they said, well, we retired a number of years ago. Well, sit down. I got some more questions I need to ask you. And this is where we get into this discussion. This third situation, I'll come back to this. The third situation is, now you got the surviving spouse that's asking the question. And let's say it's mom, and dad was the farmer, and mom and dad moved to town a number of years ago, cash rented things out, now dad died. And mom, to generate income, let's say it's income necessary to pay medical bills, whatever the case might be, sells the land. It's a passive income subject to 3.8. The answer is, again, it depends. And then last scenario gets really important because we've got potentially an additional tax that might apply. There is a special rule for farmers that was put in this passive tax. Okay? Material participation in 5 years in the 8-year period before you start drawing Social Security is evergreen. What does that mean? Okay. Let me show you how this one works by way of an example, but let me walk you through the statute first. Don't lose me as I go through this. I know this is detailed, but then I'll give you an example, show you how it works. The Act, this new Obamacare tax is actually in 1411 of the Internal Revenue Code. So it's 1411C2 where you find the trade or business provision. And it says, trades or businesses to which the tax applies. A trade or business is described in this paragraph, and you're going to love how Congress writes this stuff. If such trade or business is a passive activity within the meaning of Section 469 with respect to the taxpayer. So now you're going to jump to the 469 passive activity rules. Okay, so we jump to 469 and we go through 469. At 469H3, it says treatment of certain retired individuals and surviving spouses. That's who we've got in the office. We've got Mr. and Mrs. Farmer Bean in the office. They retired a number of years ago. They cash rent the ground out. Okay, so we stop at 469H3. Looks like this applies, so we read it. Taxpayer is treated as materially participating. And remember, if they're materially participating, there is no 3.8% tax. For any tax year, if paragraph 4 or 5 of section 2032A-B would cause the requirements of 2032A-B1C I to be met with respect to real property used in such activity if such taxpayer had died during the tax year. And so you look up and say, are you dead? And no, I'm not dead. Oh, I better read further. But it does flip us to 2032A. Hey, that's special use valuation of farmland. That's a special use provision. Well, we read on. Let's go read those and see what it says. Maybe we can pick something up. It says the taxpayer is treated as materially participating in 2032A B4 or 5 would cause the requirements of 2032A B1C I to be met with respect to real property used in farming. The taxpayer died. Okay. Requirements 2032A B1C I are met if during the 8 years preceding the decedent's death, you're not dead. No. 8 years preceding the decedent's death, there were periods aggregating 5 years or more during which the decedent or a member of the decedent's family materially participated in the farming activity. Actually, if you read this, if we drill down another layer in the statute, it says the earlier of death, disability, or retirement. So you're not dead, not disabled. Are you retired? And they say, yeah, we retired a number of years ago. When did you retire? And they give you the date that they're retired. When did you start drawing Social Security? Because that's the key. That's how the Internal Revenue Code, for this purpose, defines retirement. Receipt of Social Security. So once we figure out when the person receives Social Security, then we look back 8 years to see if we have 5 years of material participation. If we've got 5 out of 8, it's not going to matter at what point in the time in the future they sell the land. The gain is not passive. No 3.8. That's how this works. That's what that 5 out of 8 year rule means. Okay. Because 2032A B4 says that when you apply the 5 out of 8 year rule, the taxpayer disregards periods in which the decedent was retired, receiving Social Security, or disabled. So another way to say that is it's the earlier of death, disability, or retirement. Okay. The other beautiful thing about this rule is that if the 5 out of 8 year rule is met with regard to a deceased taxpayer, now we got scenario 3 that I gave you a moment ago. Mom's in the office, mom and dad had farmed, dad died, now mom wants to sell. Look at this rule. If the 5 out of 8 rule is met with regard to a deceased taxpayer, dad, it is deemed to be met with regard to the taxpayer's surviving spouse, mom, provided the surviving spouse actively manages the farming activity when not retired or disabled. So what this says is if mom's not yet drawing Social Security, mom must provide active management to get the rule. Now that's not material participation. That doesn't require nearly as much. If mom is drawing Social Security on her own, then she's automatically grandfathered in. She uses dad's material participation, even though she was never the farmer. Doesn't matter. But if dad at the time he died is 85 and he's married to the 28-year-old now widow, what are you smiling at? Not only did he die happy, but mom has to provide active management until she starts to draw Social Security. That was another joke in there, by the way, that some of you missed. Okay, here's the example. Bob materially participated in a farming activity from 7 through 11, but did not work in the activity in 12 or later years. So after 11, he retired. Okay. He started drawing Social Security in 2015, so he retired early. 2015 is the date at which we look back 8 to find 5 years. We're not going to count 12 because he's not receiving Social Security, and that's, IRS is not looking at that. They're looking, the code says retirement is defined as when you start receiving Social Security. So that's 2015. So we're going to look back 8 to see if we have 5. So that'd be 7, 8, 9, 10, 11, 12, 13, 14. Those years. Okay? 7, 8, 9, 10, 11. We've got 5 years right there. We're done. He's got the 5 out of 8. We don't worry. He doesn't have it in 12, 13, or 14, but he's got just enough. That's the reason I set it up that way, to illustrate how this works. He meets the 5 out of 8 year test. So because he had materially participated in farming in 5 years out of the 8 years before he retired, he is treated as materially participating as soon as he starts drawing Social Security in 15. Anytime forward from there, but not in 12 through 14. If they sell the land, what this means is, if he retires in 11 after 11 with this set of facts, and they sell the land before he starts drawing Social Security, it is passive, and it is subject to the 3.8. If they wait until he draws Social Security, he meets the test, there is no 3.8. Now it becomes a timing issue. What about Mary? If Bob were to die, Mary, his surviving wife, surviving spouse, would be treated as materially participating, providing that she is actively managing the farm, if she's not on Social Security yet. If she's drawing Social Security, she's okay. The 5 out of 8 year rule applies to benefit her if she retires or becomes disabled. So that's the answer to it depends. That's how you figure that. We didn't have to do this prior to 13. Now it's become more complex. But I can't tell you how many times we get this question. The other question we get is, what if I've got a farm management company that's managing my farm? I don't know if that's big around here. That is huge in Iowa. You got Farmers National in Omaha. We got Hertz Farm Management in Iowa. There are farm management companies. What if I have a paid farm manager? You're okay. You're okay. Okay? There are ways that we can get material participation to count in that situation. Congress does not make things easier as time goes by. They just keep layering things on and things on. This does, I think you can see, we took an isolated situation here of sale of land because that issue comes up all the time where it might or might not be subject to the 3.8. That's the analysis you go through. But this is another one of these factors that's out there on the table now that influences choice of entity. Do we want to be a C Corp, an S Corp, a partnership, an LLC? I haven't even got to the farm programs yet. That's coming after lunch because that influences how we want to structure things too. And we just got a new farm bill. Congress did not touch the active engagement rules under the new farm bill. So those rules stay the same. So that shouldn't impact our entity planning, although they sent a directive over to the USDA to study and come up with some new rules concerning active engagement and how it can be satisfied. Depending on what those new rules say, it's going to influence entity selection issues and structure issues. And what we get into there is maximizing farm program payments. That's a whole nother realm that's out there that non-farm businesses don't have to deal with on the estate planning, succession planning, business planning front.